Hello, everyone. Welcome back to the Daily Gold podcast. We are speaking on Thursday, June 20th, 2024. Good day for gold and silver. And with us today, we're very fortunate to have Rick Rule back, one of your absolute favorite guests. And Rick has a long bio, so I'll save us the time because, I think everyone listening to this knows who Rick is, but he might be the single most successful speculator in junior resources, as Bill Walton would say, in the history of Western civilization. The late Bill Walton, unfortunately. But Rick, we were talking beforehand, and I want you to give us a bit of a history lesson, or at least some knowledge on history, because in my research of the gold stocks, I talk quite a bit about the 1960s. I see lots of similarities between that period in the mid to late 1960s and today. And as you know, the gold stocks performed, spectacularly in the 1960s. And you always talk about how you came to the industry and really started investing professionally in the 1970s. But I'm just curious. What do you know about the 1960s?
Well, I knew a little bit after the fact about both the Spokane Exchange, which had a spectacular penny silver stock boom in the 60s. It really extended all the way to 1980. And then separately about the Salt Lake Exchange, the Intermountain Exchange, which had an equally spectacular, although less well-known, uranium boom. In both cases, you had a mixture of a few high-quality people and a bunch of low-quality people. You had networks, which, although they weren't necessarily trustworthy, relied on social trust within themselves. In Salt Lake City, that would have been what we laughingly called the Mormon Mafia, an affinity marketing group that was honorable to themselves, but not so honorable to everybody else. And you had the same thing in Spokane with regard to the silver crowd. Some great companies got built. Pegasus, it later, of course, went broke, but Coeur, Sunshine, Hecla, and then you had a plethora of penny dreadfuls, things that would be floated at a penny or 2 pennies, making use of technology that later became perfected in Vancouver, which is to say public offerings with very skinny floats, large amounts of money parked in accounts that were less than 9.9%, so didn't get reported, but were in fact related. Lots of what came to be called wash trading, which is to say transfers of stock from account to account to make the appearance of volume when in fact the stock was being crossed around the same circle of people to create the appearance of volume, which would suck in the outsiders. All kinds of abuses. I didn't know those people in the 60s, but I came to know the more prominent ones of them in the middle part of the decade of the 70s, observed their practice then, and heard their jokes about their practices from the 1960s, which were at once amusing and appalling.
Yeah, more about the 1960s. Can you talk about the Spokane Stock Exchange? It piqued my interest. I saw a tweet on Twitter maybe like a month ago or so, and so I looked it up. And on a website for Washington State history called History Link, there were some notes on there about the Spokane Stock Exchange and how numerous penny silver stocks went up more than 100x in the decade of the 1960s. What can you tell us about that period and some of the unsavory characters involved?
Well, understand that almost nobody benefited because they'd go from a penny to a dollar. Most people weren't able to get in the stock until it'd gone from a penny to a quarter. Distribution would begin to take place at 15 cents to 25 cents to 30 cents to 40 cents. And they would literally run them up and down. The market makers all knew each other. The real brokers that mattered all knew each other. The accounts that were involved in the wash trading all knew each other. Sometimes, although the stock would be held in 30 different accounts, it would actually be in one safe deposit box. And they would deliver stock from the box to the exchange to satisfy trades, and then chop up the money among the participants. So when you talk about a move from a penny to a dollar, that looks impressive from a statistical point of view, but neither the people who ran the company nor the investors actually made a lot of money in the move. You understand that at the top of this dollar valuation, the market capital of the company may have been 8 million. The market cap of the company may have been $8 million. Not like today, where a successful junior attains a market capitalization of $2 billion, where there's real bids and asks and real volume. This was more a phantom activity. And actually, the victims weren't very broadly distributed either. The victims were largely people from the rural West who heard about stocks that moved from 5 cents to 50 cents, didn't have good access to information, and were more attracted to the narrative around the move in the stock price than they were attracted to learning anything about the process of exploring or producing silver. Similar to today.
Because you hear about the performance of the 1970s and various individual small stocks, as we know. I mean, they went up hundreds of times. The junior industry as a whole, I mean, is there any? I mean, you're talking about the 1960s and the Spokane Exchange and the Salt Lake Exchange. Is there any history before that, or is that looking at everything as a group? Is that kind of the first or the first history of juniors? Because you don't hear much about juniors in the 1970s.
There were several exchanges that predated that. There was a nascent exchange in Reno. Of course, the Spokane Exchange and the Salt Lake Exchange predated the 1960s substantially. But it's worth remembering, as an example, that the Hearst fortune came about as a consequence of a very good discovery at Deadwood, South Dakota, that became Homestake. But the Hearst publishing fortune came about as a consequence of William Randolph Hearst forming one of the first tout sheets, a newsletter which supported and promoted penny stocks that he was involved in. So one could say that the origin of the Hearst fortune was based on pump and dump, and then based on their successful partial consolidation of the Deadwood district in South Dakota around what later became Homestake mining. And those were all quasi-public entities. When I say quasi, they probably weren't reporting issuers because they probably weren't required to report. But in fact, there was a very active curb exchange in various mining communities in the West, most prominently, of course, being San Francisco, which became the Pacific Stock Exchange.
Now, everything you learned about the 1960s and experienced in the 1970s, what were the one or two top lessons from that you take with you today as you try and navigate, this
It's
new
all
bull
about
market?
people. It's all about people. If you were close to Harry Magnuson in the 1960s and 1970s in Spokane, you made money. If you were close to Neil Dagerstrom, somebody who legitimately knew something about mining, but also knew where all the bones were buried, where all the scams were taking place, you made money. In the 1970s, I had the good fortune to have a regular customer at my bar named Peter Brown. And Peter Brown was the epicenter of the Vancouver Stock Exchange. And Peter didn't save me from all my mistakes, but he saved me from my most egregious mistakes. What you learned in Spokane is you paid attention to who Magnuson was hanging out with, or you watched what Dagerstrom did. In Vancouver, you paid attention to what Peter Brown and Gus MacPhail and those guys were doing. I learned really pretty early on, mercifully, that most of the value that's created in any boom is created by a very few people, at least legitimate value. And there were 5 or 6 people who used access to the money that they were able to raise both in Salt Lake City and in Spokane, to build legitimate companies. Similarly, in Vancouver, I had the extraordinary good fortune in 1974 to be introduced by Peter Brown to Adolf Lundin, the scion now of the Lundin Group. And the lesson is eerily similar. The real value is created and frankly distributed to a fairly small group of people. And most of the rest of the activity, viewed through the lens of history, is noise.
And Rick, normally we mentioned this at the end, but your conference is coming up. This is a good time to mention in the interview, but your conference is coming up, and that is a good opportunity for people to get acquainted with some of the big names and the real leaders in this industry. Can you talk about your conference for a moment?
Yeah, it really truly is. And let me do it backwards. I had an email from an attendee 5 or 6 years ago to my conference, and the email said, I was able at your conference to follow Robert Friedland around the exhibit floor and watching which booths Robert Friedland stopped in front of, and which booths commanded his attention, and occasionally listening to his questions of the other promoters was worth the price of the conference all by itself. I got the whole rest of the conference for free. As you point out, we have a feature at the conference called the Living Legends, where we invite entrepreneurs who have built multi-billion-dollar mining companies from scratch, public companies, to talk about how they did it and what lessons they learned, who they consider to be important in the business. The idea being that if you learn lessons from somebody who took a $5 million market cap to $5 billion, you'll learn something about how to identify $5 million companies that are going to become $5 billion companies. I think this is the most important part of the conference. There's lots of other stuff that's important too. We have great big picture macro guys. And if they don't teach well, in other words, if the attendees don't rank them highly on the poll, we don't invite them back next year. So you get people like Jim Rickards, Nomi Prinz, Daniela DiMartina Booth, Grant Williams, Doug Casey, Bill Bonner, people who have real big picture paradigm that you don't hear in popular media, who talk about the world the way it is, not the way the big thinkers would like you to understand. We follow that by having great analysts and portfolio managers, not people who flunked out in technology and parachuted down into gold where they couldn't do any damage, but rather analysts and portfolio managers who've made 30 years of money in natural resource markets through thick and thin. Then we have the living legends. Then we have a whole range of public company exhibitors. At every other investment conference I know, the qualification to be an exhibitor is a pulse and a check that cashes in reverse order of importance. In other words, they're advertisers. At my conference, if the conference sponsors don't own the stocks, they can't exhibit. No guarantee that because I own a stock, as an example, the price goes up. But there is a guarantee that the process is honest. We have vetted every exhibitor and we like them well enough to buy their shares. Finally, the conference has been around for 28 years. There's a core group of sort of 250 attendees who you can learn a lot from. It isn't true that all the information in the room comes from the dais to the crowd. There's a whole bunch of wisdom inside the crowd. And you're going to be hanging out with people who've worked hard speculating in natural resources for 20 years. There's a lot to learn at the bar, at the water cooler, places like that. The culmination of all that is that the value proposition is so extraordinary that I can say to your listeners, if you attend the conference in person in Boca Raton, July 7th through 11th, or if you attend from the comfort and convenience of your own home, first of all, you'll have access to conference recordings, including the breakout sessions, so that you can use the lessons of the conference for the balance of 2024. Probably equally as importantly, if for any reason, whether you attend live or via live stream, that you don't feel that you got your money's worth, email me and I'll give you your money back. Gold-plated money back guarantee. There's no other investment conference I know of in the world that says plainly, unequivocally, and honestly that the financial risk is ours. If you didn't get your money's worth, you don't pay. We would like you to tell us how we failed if we have to give you the money back so we can make the conference better, but unequivocal money back guarantee. Now, I also need to say, in 28 years of offering a gold-plated money back guarantee, I've had to refund less than 1/10 of 1% of the tuition. But that notwithstanding, because the conference is that good, the financial risk is all mine.
Yeah, that's outstanding, Rick. And tell our viewers where they can go to sign up for that.
Rulesymposium.com, or we'll forward you a link if you'd like to put it on this broadcast. It's July 7th through 11th in Boca Raton, but if you can't come to Boca Raton, you can join well over 1,000 people from thus far 30 countries, watching it via live stream on your computer from the comfort and convenience of your own home. In either case, we're going to give you 60 hours of intense, valuable content in only 4 days. So whether you attend live or via live stream, you absolutely positively should replay the tapes, which you'll have access to, the recordings, for the balance of 2024.
Okay, Rick, thank you so much for that. All right, let's get into gold and silver markets today. We talked about hated, tolerated, and loved,
Yep.
I think, in our last few interviews. So gold today, hated, tolerated, or loved?
Tolerated. The buyers have largely been foreign central banks. In fact, until the last 11 weeks, looking at physical ETF redemptions and additions, the retail buyer hasn't been in the gold market until 11 weeks ago. And the retail participation in the gold market is tepid today. So I would suggest tolerated.
Okay, silver, hated, tolerated, or loved?
Tolerated. We've had a nice move in the junior silver equities, a nice move. The kind of move that incorporates simply a dead cat bounce. They moved from being oversold. That's it. So yeah, tolerated. And I think it's worthy to note, sorry for the editorial comment, when people look at the discrepancy between the move in gold and silver and the gold and silver shares, and they wonder why it is, I think it's pretty easy. The buyer of gold has been foreign central banks, and they don't buy stocks. That's not what foreign central banks do. So the group, the coterie that moved the market were gold buyers, not gold stock stock buyers. And I think that explains 90% of the delta between the move in gold and the move in the gold and silver stocks. Really simple explanation.
So when do you think we are going to see more buyers come in and buy the gold and silver stocks, which, I mean, I know people are unhappy with them, but I mean, they've had a good move in the last 3 or 4 months.
I mean, anybody who hasn't enjoyed the move in the last 3 or 4 months needs to give their head a shake. They need to become a postman or something like that. We've had a tremendous move in the gold and silver stocks. I still believe that we're in the early innings, because I believe that the gold price over the next 5 years will really, truly surprise people. I believe that we're going to have a mixed earnings quarter. People look at the increase in the gold price and they think that that's going to be immediately reflected in operating margins, not understanding that the costs of producing gold, particularly the social costs, off concession expenses, taxes, and royalties, have been increasing at 20% compounded. So you are going to see some operators. Endeavor Mining would be an example. I think Agnico Eagle will be an example. You will see some companies that really surprise you in terms of the margins. You're going to see other companies that probably surprise you a different way in terms of margins this quarter. but I think margins are now on their way higher. The moderation in energy costs is an example. The movement in the last 3 years of the oil quote from, $40 to $90. These operations are really energy intensive. It now seems like, as an example, the oil price is plateauing, which means that the increase in operating costs that we saw from energy costs, a quadrupling in energy costs over 4 years, probably behind us. But you are still going to see higher social costs. You are going, I think, to continue to see shortages in skilled labor, which means that the labor costs are going to go up. I think the increases that we've seen in consumables, cement, and steel are probably over for a while. And I think that you're going to begin to see margin creep up, which will help the precious metal shares. It won't help the penny dreadfuls. We're going to need to see strength in the real gold and silver stocks before we see the strength in the junk.
Okay, Rick, I think last time you mentioned developers were your favorite or the best value or the most undervalued in regards to developers, producers, and explorers. I mean, any change to that? What would you, if when I ask you about those three subsets, I mean, what pops out to you? What do we need to know right now?
Yeah, I mean, I think I tried to qualify that for your listeners. If somebody came to me and they wanted to establish a gold portfolio, the first thing I say is, okay, let's buy some gold. If you think gold's going to move, let's buy some gold first. And then let's buy the highest quality participants. So we'd go to the Franco Nevadas, the Wheaton Precious, the Agnico Eagles, but that's not what your audience wants to hear. Your audience is younger, more aggressive, and they can afford to be because they're younger. In that subset, the developers appeared to offer the best relative value. Lobo Tigre, who I believe has been a guest of yours, but perhaps not, did some wonderful statistical work about what he calls the golden runway, which are companies that have made production decisions where they've obtained the permits and they've obtained the financings. And he showed statistically that a sample of those companies, I think there were 80 of them over 10 years, had an average gain from first shovel, which is to say, really truly production ready, to successful completion. They had an average gain, which took an average of about 2 years, of over 100% in any precious metals market. That juxtaposition of risk to reward at that company scale size told me that universe of stocks was the universe that in the market that exists today was the most suitable to the audience that I would likely be talking to on your broadcast. And I continue to believe that.
Give me some thoughts on producers. I mean, we've seen some of them move, others have had problems. So going from actually building the project to then actually being in production.
Depends on how speculative you are. I don't like to speculate in the junior producers. In other words, I don't like to buy the junk producers because they give me quantum returns when the gold goes up. I don't want to do that anymore. I've learned that the market beta in a gold bull market is good enough that I'd rather make a little less but take a lot less risk. So I like high quality producers. I like producers that have 10-year track records, that are in the best quartile in terms of return on capital employed, where the managers who generated that return on capital employed are still employed. In other words, where the people who generated the track record are still doing it. And I like to see deposits that operate in the best quartile in terms of all-in sustaining costs. What that means is that I'm fairly conservative with my producers. Do they have names? Sure. Alamos, Agnico Eagle, Lundin Gold. In terms of the developers, I look for people who, although they're developing now, have successfully developed and operated in the past. I want a track record of success. So G Mining, which recently acquired Reunion, or is in the process of acquiring Reunion, would work on that. Multi-asset companies, the Australian company Emerald comes to mind there. Somebody who has been serially successful in the acquisition of developable projects, develop them, and then operates them successfully. And even while they're operating them successfully, recycles the free cash flow from today's operation into tomorrow's opportunity. Yes, there's absolutely a place there. What you need to understand, and your audience is going to hate me for saying this, but if you invest in the sector, either in the junior sector, the intermediate sector, or the senior sector, without doing adequate stock selection, you are going to lose money. And if you invest in the sector over time, you're going to go broke. You need to understand that all of the risk-adjusted return in the sector is generated by 10 to 15% of the listings. And people really, truly need to understand that. The historical demonstration of that is the decade 2000 to 2010, when the gold price went from $250 to something like $1,900. The free cash flow per share on the XAU in that 10 years declined. It took real skill to turn a seven-fold increase in the selling product of their commodity into declining free cash flow per share. What that tells you is that irrespective of the sector you pick, rank exploration, prospect generation, royalty and streaming, developers, producers, you need to be extremely careful in stock selection. And you need to be merciless if the reason that you own a stock ceases to exist. If you bought a stock because you're expecting XYZ drilling result and you don't get the result and the share price falls from $1 to 65 cents, you have to sell it anyway. If the reason to own a stock disappears, the stock has to disappear.
Okay, Rick. Make the case for investing in or speculating on exploration companies, because you look at developers and the good producers. I mean, they have an asset, they're making money. So then if a certain part of the exploration companies, they're on the younger side, maybe they don't have a big resource yet, or they don't have a resource, what's the case for investing in those versus the other groups? Or is it just, you look at everything?
First of all, Jordan, all the money that I now invest carefully, my wife will tell you that I made by speculating aggressively. So if you are willing to do the work, if you are disciplined, and if you have the psychological stability to handle both risk and volatility, speculation is useful because you can make a stunning amount of money. I didn't make Bill Gates style money, but I made more money than I knew existed when I was a young man. I'm the son of a single mother school teacher. We sometimes ran out of money before we ran out of month. And I didn't want that situation. And I was able to escape that situation by working hard and speculating. Information is unevenly distributed among the juniors. There's a whole bunch of people that follow Barrick. There's a whole bunch of people that follow Franco-Nevada. You don't need to talk to Rick Rule about that. The information is well distributed. Publicly available documentation is good. So it's very difficult to outcompete other investors, at least in terms of knowledge. But things are very different in the juniors. There's very little research on $50 million market cap companies, and that research is usually distributed by investment bankers who hope to profit from underwritings, which is to say that the situation of information distribution at the top is fundamentally dishonest. Many of the pundits in the space don't know much. They're good salespeople, and they regard, they're advertisers. They're basically touts for the company. So you need to do the work. But if you do the work, the quality of your peers, of your competitors, is so low that it's difficult to get under the bar, not over. You just need to understand something about how money is made in the juniors. First of all, as we talked about in the onset, all the money is created by 10% of the participants. I mean, people need to realize that. If you merged every public junior in the world into one company, Junior Explorco, that company would lose $2 billion in a good year and $8 billion in a bad year. So that you need to understand that only 10% of the listings are viable. Your job as an investor is to throw away companies, throw them in the circular floor file, never waste any more time looking at them. segregate by companies that are run by serially successful people where their expertise is applicable to the task at hand, not just success, but success applicable to the task at hand. You shouldn't sucker for the bootstrap idea. You shouldn't sucker for the idea that you're going to open a small mine, use the free cash flow to build a bigger mine, not dilute, and end up building BHP from some shitty project, nothing, nowhere, that kind of thing. Everything that go wrong with a big mine can go wrong with a small mine, but a small mine can only ever make you small money. So the size of the prize has to be attractive. And importantly, you need to know the business plan. You need to have the company tell you what the most proximal unanswered question is that separates the market from knowing more about the deposit. In fully 80% of the time when I've asked management that question, they haven't been able to answer it, which is to say 80% of the managements that I've interviewed over the last 40 years didn't have a business plan other than trying to make sure that their salary was paid 18 months hence. That's valuable information in and of itself, because if there's 3,000 public companies and there's 300 that are viable, throwing away the 2,700 is the way that you have the time to lavish the attention on the balance that you need. And then learn to love hate. That's really important. In 2022, when I looked at the social media comments around uranium, it was very clear to me that I had no competition. I was in a no bid market. So I didn't have to pay attention to the 65 remaining uranium juniors that had survived the uranium washout. I had to find the 10 best of those. And I had no competition. I had no competition. And I knew that with uranium selling at 20 bucks a pound, that if the uranium price didn't advance to $60 a pound, the then existent total cost of production, that the lights were going to go out, that we weren't going to have electricity. This is a no-brainer. This is an absolute no-brainer. So should people participate in exploration? If they're willing to do the work, if they're willing to discipline themselves, if they're willing to listen for music, but not noise, absolutely. I can't tell you how many 10-baggers I've enjoyed in my life. Now, I've enjoyed a vastly greater number of companies that have cost me 25%. In other words, I lost 25%. But the wonderful arithmetic of speculation is that a 10-bagger makes you 1,000%. And if you make 1,000%, you can afford a few 25% losses. If you have the psychological and financial wherewithal to stand that trade.
Rick, can you share the last gold or silver stock that you bought?
Ah. Jesus, this is going to sound like a fudge. I'm so old. I'm 71 years old. I participated in a private placement yesterday of a nascent African explorer and producer. And I'll have to email you the name. That question came so directly out of the blue that while I remember the experience, I can't remember the name. That'll give your viewers some idea of the senility of your guest.
Oh, I don't know about that. What about one that's is that one's not publicly trading yet?
It is not. It is not. It is not.
Can you mention your most recent buy that
Yeah, my
is
most
publicly
recent
traded?
My most recent buy on market was Mondoro. I don't know the symbol. It's a prospect generator run by a brilliant young woman named Theo Deschev. Despite her young years, she's been in the exploration business 20 years. She's a prospect generator. The company has a market cap below $30 million Canadian. It's actually free cash positive from exploration fees after G&A. There's a company with a $30 million market cap that's going to generate $1.5 million or $1.6 million in cash, with little tiny partners doing my due diligence for me, like BHP, Rio, Antofagasta. So yeah, that would have been my last on-market purchase. Now, don't everybody go out and compete with each other to buy the stock. It's extremely thinly traded. Uh, I'm using it more as an educational tool in this discussion
Right.
than a stock recommendation.
Right. Understood. Um, Rick, I guess last question. Does your strategy change at all given that, okay, we've seen this nice move in gold and silver. It looks like we're in the early innings of a bull market. Does your strategy change now compared to, let's say, like a year or 18 months ago?
Yeah, I buy with less impunity now. The move is more imminent, but the values are also less extraordinary. There were circumstances as recently as 6 months ago in the silver exploration space where everybody hated it. I could look at deposits. Abra Silver would be an example. Vizsla Silver would be an example, where it was perfectly clear to me from the exploration results. And you didn't have to be a PhD structural geologist to understand these results. You could look at the plan view, you could look at the cross section, you could construct your own cross sections with a pencil. You didn't need a computer. And you could say, you know what, this is a mine. And it isn't just a mine, it's a good mine. And the stock would go down. They'd release a wonderful drill hole that was confirmation of some part of the exploration thesis, like a down dip extension or an on strike extension. Uh, a drill hole that gave you really good, really valuable, really positive information, and the stock would go down. For somebody like me, that's nirvana. It means that you can employ the intellectual capital that you've already spent to generate more physical capital. Those times are done. People look at Vizsla now as an example. They drill an on-strike extension or they drill three infill holes, and the grade reconciliation is up as opposed to down with greater density. And the stock, as it should, moves up. There's greater certainty around the outcome, and the market isn't pro-silver, but it isn't anti-silver either. So 6 months ago, I could buy some of the higher quality exploration companies with total impunity. And that was a better circumstance for me.
Rick, on that note, I'll wrap things up because I know you're very busy. I mean, you say you're retired, but I mean, you have the real symposium, you do the boot camps and the classrooms, and you just started a new bank. Tell us about Battle Bank.
Well, thank you for that opportunity. You can see the Battle Bank jersey. I would start by saying any of your listeners who are unhappy with their current bank, which I suspect means all of your listeners, should go to battlebank.com. It's the second bank that this team has done. Our first bank, EverBank, we launched in 1999. One of the first online banks. If you aren't smart enough that this here, your phone or your computer, can't be our branch, don't come to us. If you need a dumb people's bank, then go to Wells Fargo, go to Bank of America. If you don't need a dumb people's bank, because we're branchless, we have a point and a half less non-interest expense, which we can pass on to you as a depositor. So unlike the big banks, we will pay interest on your checking account. We don't have 16 deposit products, 6 of which don't pay you interest. We will be in the highest quartile of interest payers among American depository institutions. We also have an interesting assets queue. We will be the only major bank in the United States that considers gold and silver to be good collateral. So if you hold gold in a segregated account at Brinks, Loomis, or Viamat, at some reputable audited depository, we'll establish a margin account against it. It seems mercifully for me that my competition at Chase, places like that, Bank of America, Wells Fargo, they either can't spell gold, maybe that's what it is, or they don't consider it to be good collateral, but I do. So that's what Battle Bank is all about. We really named it Battle Bank because we want to battle for better banking. And if your relationship with your existing depository isn't what it should be, we would love to talk about having your business.
Rick, one more thing before I forget. So rulesymposium.com. People there can sign up for the conference. If you can't make it to Florida, you can, as you say, you can enjoy it from the comfort of your own home. But also, Rick, where can our viewers go where you will rate their portfolios and provide a comment or two?
I love this. I've done it 80,000 times now in the past 6 or 7 years. Go to ruleinvestmentmedia.com, list your natural resource stocks. Please no crypto, please no tech stocks, just your natural resource stocks. I'll rank them 1 to 10 and I'll comment if I think my comments might have any value. If you want to know more about my bank, at the question and comment section at Rural Investment Media, just write bank. And we'll send you more information about Battle Bank. But I love ranking people's portfolios. I learn as much as I teach.
Let me give you one. Maybe you can rank it. Moose Pasture Silver Mines. Where would that rank for you?
Consolidated Moose Pasture Silver. That's an absolute short. That would be a 10, the worst possible rank. A 10 is a bankrupt company run by fraudsters. That won't exist 5 years from now, one that you should short with impunity.
Okay, Rick, thank you so much for coming on today. I and my viewers, we really appreciate it and wish you all the best with the conference and everything else you're doing.
Well, Jordan, thank you for the opportunity. I appreciate it.
Thank you for tuning in to the Daily Gold podcast. For more interviews, editorials, and analysis, log on to TheDailyGold.com. And for premium coverage of precious metals and the best junior mining companies, visit TheDailyGold.com/premium.